Greetings and welcome to the Superb Diamond Range podcast. I'm your host, Superb, broadcasting from Edinburgh. Today's date is December the 1st, 2021. If you enjoy the content, please like and subscribe on YouTube and be sure to check out our Twitter at SuperbDiamondRA. I'm thoroughly delighted and honoured to be interviewing a true legend of the financial independence movement, a man who has inspired me and many others in their investment journey by proving it can be simple and straightforward and not as complicated as you think it will be. He is the author of one of my favourite financial books, The Simple Path to Wealth, as well as the founder of the fantastic blog, The Stock Series, and really needs no introduction, JL Collins. So this will be episode 50 in the financial series as well. Due to the topics we'll be covering on this episode, I'm just going to read a brief disclaimer. We are not financial advisors. The content on this podcast and YouTube videos are for educational purposes only and merely cite our own personal opinions. In order to make the best financial decision that suits your own needs, you must conduct your own research and seek the advice of a licensed financial advisor if necessary. Know that all investments involve some form of risk, and there is no guarantee that you'll be successful in making, saving or investing money, nor is there any guarantee that you won't experience any loss when investing. Always remember to make smart decisions and do your own research. So without any further waiting, welcome JL. It's a true pleasure to have you on the show today.
Well, it's an honor to be here, Stephen. I appreciate the invitation.
Oh, no problem. Delighted to have you on. It's so great. Okay, so JL, many people will already be familiar with yourself. Just for those who aren't, tell us a brief little bit about yourself and your early career up until today and how you got started investing.
Well, that covers a lot of ground. We could probably take an hour answering that question. But briefly, my professional career was in the magazine publishing business. So really nothing to do with investing. Investing was more of an avocation. And it was something that I enjoyed and something that I thought was extraordinarily important. And it was something that I tried to pass on to my daughter. And I made the mistake of pushing it way too hard, way too early. And I managed to turn her off to all things investing. Now, who knew a 4-year-old wouldn't want to sit down with the Wall Street Journal and go through it? But there you go. And so anyway, when she was coming up into college, I thought, I better write some of this stuff down just in case I'm not around when she finally and hopefully takes an interest. So that was the start of the blog. I just saw it as a way to archive this information I wanted for her. And I had no idea that it would grow into the international audience it enjoys now. I had no idea that it would give me the material to put together The Simple Path to Wealth. And now my newest book, How I Lost Money in Real Estate Before It Was Fashionable. I had no idea it would lead to the events that we host, Chautauquas, that are coming back next year. They've been on hiatus with COVID. My daughter likes to point out to me, Dad, if I'd listened to you, you wouldn't have any of these things. So maybe I'm lucky that I turned her off to it, but she's on the path now, and that's what counts.
That's brilliant. And so I take it that was what mainly got you into investing. Was it just sort of after learning it, being able to teach it to somebody else was like important?
Yeah, I wanted to pass it on to my daughter, certainly. I got into investing because I watched my father's health decline, and he was in business for himself, and as his health declined, our standard of living declined pretty steeply as well. And he was not an investor. He didn't have anything other than his ability to earn income, and as that diminished, things got tough. So I determined early on that I wanted to make sure I as soon as possible, I wasn't reliant only on my ability to earn income. I wanted to have money working for me. So that was the beginning of my journey.
Excellent. I've heard you mention in other podcasts like Choose FI, Mad Scientist, that you had gone through a time where you picked individual company stocks, particularly in your early days before discovering index investing. Do you still like to pick the occasional company these days? And also, what would you say are the dangers for investors that should watch out for this type of investing?
Yeah, so I call it the disease. I guess I'm a recovering addict in a sense. I haven't owned an individual stock probably since, I probably let go of the last one around 2013, 2014, something like that.
Okay.
So I carried on with them well into my indexing conversion, if you will, when indexing was doing the heavy lifting in the portfolio. But when you're picking individual stocks and you get it right, there are a few things in life more intoxicating than watching that thing climb and the pride that you take in the fact that, oh wow, I picked a winner.
Yeah.
The problem is that picking winners consistently is extraordinarily dangerous, and then of course once you pick them, you have to figure out when the run is over and when to sell them. And the research is pretty clear that even the best professionals with the best tools at their disposal fail almost universally to outpace the indexes. So the idea that an individual can do it seems to me to be a bit of a fantasy. I think the reason that it was hard for me to make the transition, and probably the reason it's hard for a lot of people who are picking individual stocks, and by extension mutual funds that are actively managed by people picking individual stocks, is that it's not like it doesn't work. I actually achieved financial independence doing exactly that, picking individual stocks and actively managed funds. The reason I prefer indexing is indexing simply works better, and it's simpler, and it's easier, and it's more powerful. But it's not a matter of one is bad and one is good. As I say, if you do your homework, you can certainly enjoy success picking individual stocks, but you're probably not going to enjoy as much success. It's a very rare person that does, and you're going to work a lot harder at it. And it's a never-ending challenge, as you're always wondering, once you've made that decision, when you're going to get rid of them next and what next to buy. So The indexing is simpler and more powerful, and why bother with individual stocks once you figure that out?
Yeah, no, totally. So when did you realize that you were financially independent, and once you did realize it, how did you feel about it? What went through your mind?
That's actually kind of a funny story, because it's important to remember that when I began this journey, and I first started investing in 1975,
yeah,
there was no internet. There were no personal computers, for that matter. I had no concept of being financially independent. In fact, I didn't come across that term until after I started my blog in 2011.
Yeah.
All I knew was that, as I said earlier, I wanted to have money that was working for me. I came across sometime in the 70s a novel by James Clavell, Noble House, and there was a character in there, and her stated goal was to have what she called FU money. And that was the first time I'd heard that term. I take pride in popularizing it in the financial independence community, but it's not original to me. But it immediately crystallized what I wanted, and that was the goal. But I didn't have a goal of retiring early or not working. I enjoyed my work. I didn't like to do it all the time, so I liked having enough money to back me up that I could step away from it for personal sabbaticals periodically, which I did throughout my career. But I really didn't have any concept of retiring early, or even financial independence in the sense where you no longer had to work for money at all. And when I first realized that was the case, it was probably around 1990. I had quit a job, and it turned out to be the longest stretch between jobs. It ran to about 5 years. And about 3 years into that, I was at the end of the year, I was kind of totaling up all of our expenses, our investments, and where we stood. And I noticed something really odd, and that was that we lived our normal lifestyle. We'd paid all our bills. We weren't, cutting back or doing anything differently. And yet, at the end of the year, we had more money than when we began.
Wow.
And I knew something remarkable had happened. I didn't have a name for it.
Yeah.
And then I went back and I looked at the previous years and thought, wow, that's been the case for the last couple of years, ever since I quit my job. And then my wife quit her job in that same time period because our daughter was born and she became a stay-at-home mom. So I knew something remarkable had happened, but maybe embarrassingly, it never occurred to me that oh, this means that you never have to work again.
Yeah. Yeah.
But I guess that's what it meant. But I liked working, as I said, so that
So
was kind of a non-issue.
it's amazing because, like, a lot of people, it's like a goal now, and it's something that they're aiming
Yeah.
for. Whereas, there's people that come across it accidentally, or as you say, you kind of realize after a while that that's been happening automatically, but you didn't plan it, or now all of a sudden you're like, wow, this is incredible, like what amazing
Yeah.
discovery sort of thing. So that's good.
Sometimes I wonder if I'd had this awareness of financial independence and if it had registered in my head that, wow, this means that I no longer need a paycheck. Sometimes I wonder if I'd known that more clearly, if I would have done anything differently. And I don't know the answer to that question, but it's kind of fun to speculate once in a while.
Yeah, sure. So I did come across an excellent video referencing a scene from the remake of the movie The Gambler. My idea of how I'll feel when I hit financial independence is just like at the end of that movie, where Mark Wahlberg puts everything on black on the roulette table, wins and pays off all his loans and to his debtors and loan sharks, and goes for like a never-ending run around the block. How did you come up with the idea to make this video?
So when I saw that movie, and of course the video I made is a takeoff on a very brief clip when John Goodman, who plays the loan shark, is sitting in the bar with Wahlberg, and Wahlberg's trying to borrow the money to get back into the game, and Goodman is basically telling him that, if you borrow this money and you don't pay it back, I'm going to go after you. I'm going to go after your family. I'm going to go after your descendants. And there's a lot at stake. And at one point, he asks him, how much money, do you have, or how much are you up? And Wahlberg says something. Oh, I've been up $2.5 million. And he says, well, how much do you have now? And he doesn't have anything. And then Goodman goes into this monologue, and which is just, I thought, brilliant. Yeah. And the moment I heard that, I wanted to modify it to match my investment approach, but with the same tenor. And so I tried to keep it as close to the dialogue, the original dialogue, but again, modifying it as I needed to. And I wound up with a 97-second clip that has become somewhat famous, and because of the language in it, if anybody's sensitive, somewhat infamous. So, it might not be suitable for work or children, but I had fun doing it, and a lot of people seem to have fun listening to it.
It's quite funny because a lot of people that would come into that sort of money the first thing that they'd want to do, usually, especially over in the UK and Ireland, would be like to put it into a property, if they had that much money. And it was so different, in that you were saying just put it all into like an index fund, 80-20. I thought that was, because sometimes, that's a good thing to do first, because that, generates an income, and then, you can, other things will come from that. But, immediately people want to just buy a house because it's, something that they've always wanted to do, or they don't want to have a mortgage anymore, that type of thing. So it's just a totally different way to do things, but it makes total sense to do that first, what you're suggesting.
Well, that was actually the key thing I modified from the original, because in the movie, that's what Goodman advises.
Said, yeah.
Get yourself a house with a 30-year roof, or or like that. And I don't particularly. While I've owned houses most of my adult life, I don't think they're investments, and I don't think they should be the centerpiece of the way you build wealth. So
I agree
That's
with you on that.
one of the
Yeah.
things I modified, and basically in the clip I say, don't buy a house.
Yeah.
Rent yourself a nice place on the landlord. Worry about fixing the toilets
Totally. It's brilliant
yeah.
advice.
So that's one of the. So if anybody listens to it, they can certainly a little Google search will get you John Goodman doing the original, and if
Yeah.
anybody cares that much, they can see how I differ from. But the advice in the movie is very much the traditional advice you described,
Yeah.
which is the way most people think. They think, well, the
Definitely.
cornerstone to building wealth is to own a house, and
Yeah.
I just don't see it that way. Houses are an expensive indulgence.
Definitely. I totally agree.
That's the
Totally
way I
agree.
look at them. And as I say, that comes from a guy who's owned them for most of his adult life. So it's not that I'm opposed to them, but I'm opposed to the propaganda that it's a great investment.
It's like a religion in America and over here. Like
Yeah,
everyone's just
exactly.
all they care about is property. Like, and there's loads of TV shows about property and stuff like that over
Oh,
here.
it's
So
it's the same here. Yeah. Somebody, not me, called it the American religion.
Yeah.
I think it sounds like it's the British religion as well. But
Totally. So I wanted to get your review on active versus passive investing, because obviously there's a lot of hype around active funds, and just to get your opinion on the two of them, and if you think they have a place in someone's portfolio, or if you think it's better just to focus on passive investing.
well, we touched on that a little bit early in the conversation, and the short answer is no. I don't think they have a place.
Okay.
I simply because index funds are not only simpler, they're more effective, and they're less expensive.
Yeah.
And sometimes people say, well, index investing is boring. And well, they're right. It is boring. You set it and forget it. But your investment shouldn't be a source of entertainment for you.
Yeah.
If you want entertainment, go to Las Vegas and play roulette or roll the dice or whatever. Your investment should make you wealthy. They should ultimately support you. They shouldn't entertain you. You shouldn't expect them to entertain you along the way.
Absolutely.
And so I kind of cringe when people say, "Oh, buying and selling stocks is fun," and it is. Like I said, there are a few things more intoxicating than picking a good stock and watching it run. But that's not the best way to become wealthy. And to me, that should be the goal of investing. So I let the index funds do the heavy lifting, and then I seek my fun elsewhere.
Yeah, totally. So your approach to investing has influenced and inspired so many people, including myself. How did you discover this approach or this strategy? How did you come by it or develop it, I guess? Or
Well, I came by it slowly, and I'm a little embarrassed to admit that. So, I started investing in 1975.
Yeah.
And coincidentally, that was the year that Jack Bogle, who founded Vanguard, brought out the first index fund based on the S&P 500, which are the 500 largest companies in the U.S. I didn't know about that in 1975. I didn't hear about it until about 1985, 10 years later. But even when I heard about it, I was very slow to adapt it. It probably took me 10, 15 years, I don't remember exactly, before I embraced index funds. Because it is kind of counterintuitive. It's, at least for me, and I think this is probably true of a lot of people who pick stocks and actively invest, is you look at it and you say, well, the basic premise of index funds is you just buy everything, and that somehow you're going to outperform. And if I'm an active investor, all I have to do is avoid the bad stocks, and I'm going to beat the index. Or all I have to do is buy the best stocks, and I'll beat the index. And that sounds logical and reasonable and obvious. The problem is that in the real world, it's extraordinarily difficult to do those things, because those best stocks today are tomorrow's Enrons. And maybe I'm testing some of our audience, but Enron was a very widely, highly regarded U.S. company that collapsed in 2007, 2008, somewhere in there, which was part of the whole economic collapse in those days, caught everybody by surprise. So the problem is those great companies can be tomorrow's disaster story, and those those losers that look like they have no future can be tomorrow's exciting turnaround stories.
Yeah.
And it's very difficult to figure out when and which ones that's going to happen with. With the index, I don't have to worry about it because the index is self-cleansing. That's a term I created and I'm proud of.
Heard
What
you
it
say that.
means,
Yeah.
what it simply means is that as stocks do well, because the index is cap weighted, you will own more and more of the winners by definition as they begin to fade, and all companies have a lifespan, and all of them ultimately begin to fade. They will drift off your portfolio and be replaced by the new companies that are created in a capitalist society all the time. And you will always benefit from that. And you don't have to worry about when to sell and when to buy because your portfolio is always self-cleansing. In the U.S., by contrast, by the way, in the late 60s, early 70s, before index funds were created by Bogle, somebody came up with the idea of the Nifty 50. And that was simply they went through and they picked what were then the best U.S. companies and said, if you bought these 50 companies, these 50 stocks, and just put the certificates in your bank, in those days you got paper certificates, you could forget about them and your investing was done. Well, the problem is the Nifty 50 didn't have the self-cleansing aspect that an index fund has.
Yeah.
You just owned those 50 stocks, and they were companies like General Electric and General Motors and Xerox and Polaroid and Sears and companies that were hugely powerful and successful back 50 years ago, which are now hardly spoken of and many of which disappeared.
Totally.
So that's what I think the key thing that makes indexing so powerful is this self-cleansing process. And of course, that's the key thing that makes it easier too, because you can buy it and forget it.
Totally. Yeah, it's the beauty of it, as they say. So just wanted to get your thoughts. I have seen a few of your blog posts about this, but just wanted to get your thoughts on international investing, versus going all in on the American market, using, say, either the S&P 500 or the VTSAX, which I've heard you reference in many videos. Just wanted to get your thoughts on that, because I know you have mentioned things about the cost. Obviously, it's a lot cheaper to invest in America. There may be tax advantages. There could be, I'll let you speak on it. Let's see what you think in regards to that.
Sure. So the first thing anybody listening to this should understand is that I am an American. It's probably obvious hearing my voice.
Yeah.
And I write from a very U.S.-centric point of view because that's what I know.
Yeah.
And frankly, I never dreamed I'd have an audience at all, let alone an international one. So I really know very little about the nuances of investing in other countries and the tax laws and what's actually even available. So that's point number one. Point number two is in my writing, I do make the case that all an investor needs, and I'm talking about a U.S. investor at this point, is VTSAX, which is the total stock market index fund for the United States.
Yeah.
The reason for that, of course, is the United States is such a dominant economy in the world. I also said at times that at some point, as the rest of the world continues to grow and prosper, that dominance in the U.S. will probably decline. In fact, it has declined as a percentage of the world GDP since World War II. And after World War II, and every developed country in the world was in ashes other than the United States, and the U.S. probably made 95% of the world's GDP at that point.
Yeah.
But it was a much smaller pie, and as the rest of the world got back on its feet, that pie got bigger and bigger, and the U.S. portion of it got smaller and smaller, which is a good thing. It's a good thing for the world, certainly, but it's also a good thing for the U.S. It's, you're better off having half of a huge pie than 90% of a much smaller one. So that's kind of the dynamic that is going on. So at some point, U.S. investors will probably want to think more internationally. But right now, I don't think they have to. For international investors, or at least international from my point of view, I kind of talk out of the other side of my mouth. If I were in any other country, I wouldn't be buying just the index for that country because the economies aren't big enough. I'd be buying a world index, quite honestly.
Yeah, makes sense.
The cheapest index I could find, and Vanguard has a good one. I can't think of what it is offhand, but that invests all around the world, and then you get each economy from the world proportionate to its size of the world GDP, and that will again be self-cleansing in that as those dynamics change and certain parts of the world grow and prosper and others maybe stagnate, that'll be reflected in what you own in a positive way. So that's what I would do if I were in any country other than the U.S. And I think ultimately that'll be the advice I would give to U.S. investors. But right now, if you're in the U.S., you have kind of a unique advantage that the rest of the world doesn't have, at least for the foreseeable future.
Definitely.
I tell my daughter this is something I probably don't have to worry about, but she'll probably want to keep an eye on.
Yeah, definitely monitor it over the next decades or so. Just sort of along that same theme of international, I know there is a lot of Canadian people that have an approach to indexing, possibly inspired by the Bogleheads, to invest in a split three ways, which I believe is into Canada, USA, and international. Whereas in the UK, we just pick a global index fund that allocates and readjusts in the proportions of the global GDP. Like I get being overweight in US if you're a US resident who spends in US dollars, and with USA making up 50 to 60% of the global market. But being, say, 33% in Canada seems like a lot. Admittedly, stock index from home countries are usually offered cheaper and may have some tax advantages. What's your thoughts on being overweight in a home market? And do you think that's quite risky? Obviously, not referring to America in this example, but let's say you're in Canada, and I think they're only something similar to UK, their percentage of global GDP. What's your thoughts of being 33% in Canada, for example?
Yeah, that would make me very uncomfortable if I were Canadian. And again, I don't know the specifics of it. And you mentioned that you could buy home market indexes for much lower costs, and lower costs are very important. But it would have to be a very, very strong cost incentive to make up for especially overweighting 33% in all due respect to Canada, what's a very small economy, an economy that, if I understand it correctly, is heavily dependent on the natural resources sector.
Yeah.
And I think there's one other sector. And of course that, when you're focused on one sector, that's also a risk factor. So no, I wouldn't do
totally.
Unless the cost incentives were just overwhelming. And again, I don't know the nuances that are involved there. So taking, with that caveat, I'd do what you just suggested. If I were in any other economy other than the U.S., I would be buying a world fund.
Because quite interestingly, I don't know if they would have them in Vanguard USA, but in the Vanguard UK, we have, I believe it's life strategy funds that kind of overweight the UK, but they also have a bit of a global split as well. And I could be wrong, but I think the UK weighting is 20 or 30%, and then it's like a mix of other global, countries. But these are quite popular in the UK because they're quite easy and they're quite cheap, and cheap funds to buy. But I've just never been comfortable with the idea of having so much in the UK economy, like similar to what you said about Canada, about the focus being mainly sort of banking or oil companies, and it's just not like got the range of like the global economy, or what the range that America has of different, you know, sectors that it covers and things like that. So
Yeah,
I
no,
feel uncomfortable.
I would agree with you if I were a Brit, or if I were in France or Canada or New Zealand, or, you know, I would feel the same way. The U.S. it creates a unique environment
Definitely.
for those of us in this country, and again, I think that's an environment that is destined to go away ultimately, and eventually U.S. investors, probably like my daughter, will want to turn to the World Fund as well. But yeah, I would, you know, and it's not a matter of patriotism, in my opinion, and maybe that's why they create funds like that, because they think, well, the people in that country buying that fund want to see a better weighting of their own, or support their own economy, or what have you.
Yeah,
And
definitely.
that's fine if you want to do that, but now you're not talking about investing anymore. You're talking about politics and that kind of thing. So,
Yeah.
and again, I am a believer. I don't expect my money to entertain me. I don't expect my money to represent my political point of view.
Yeah. Yeah.
I expect my money to make money. I expect my money to work for me. And
Totally.
when you start asking your money to do anything other than that, then it's going to be, in my opinion, it's going to become less effective in doing that core thing of making money for you. So,
Absolutely. So yeah, I'd like to just talk to you about market crashes. You know, obviously it feels a long time since 2008 crash, and it has been. Admittedly, there was a weak correction in March 2020, but markets soon bounced back. How do you handle these emotionally and stay focused to continue investing, particularly if you're a younger investor, and also, you know, realizing that there's an opportunity to buy more shares cheaper during that period? Just wanted to get your thoughts on that.
yeah, that's a great question. I think the first thing I would say is that anybody who invests in the stock market has to understand, and not just in their head, but deep in their gut, emotionally understand that the stock market is very volatile. And as you point out, other than that brief time in 2020 around COVID, which, by the way, a lot of people were expecting to last for decades, and
Yeah.
were happy to tell me that I was wrong about the market would recover on that, and it lasted for weeks. But we've really lived in since the crash in 08, 09, we've really lived in the last decade plus in a charmed environment. And I think maybe a lot of, especially younger investors who have never experienced a real crash, don't understand how impactful it can be. But you have to understand that the market is volatile. If you're going to invest in the market and you're going to get the benefit of investing in the market, you simply have to accept the volatility. You have to accept that you can wake up tomorrow and find out that your portfolio is suddenly worth 50% less than it was when you went to sleep. That's a very rare event, but it's an event that has happened in the past. And I told my daughter she can expect to happen at least once, maybe a couple of times in her investing career. It's part of the process. It doesn't mean the world's ending, although the media will be telling you that it is. Doesn't mean that you should panic and sell everything. That's the worst thing you can do. It just means the market is doing what the market typically does. I like to say that, you know, if you live in New England here in the U.S., which is the far north, you shouldn't be surprised that there are blizzards.
Yeah.
They're major, and some of them can be very dangerous and very disruptive and very uncomfortable and very unpleasant. And they're just part of living in that part of the country, that part of the world. And you just have to be prepared for it and understand that blizzards don't last forever, and they're a natural part of the process. If you live in Florida or in the Caribbean, you know, hurricanes
Yeah.
are very dangerous, very unpleasant, but they're part of the process, and they
Definitely.
don't last forever either. So it's the same thing with market crashes. It is part of the process. And here's the other thing to keep in mind is nobody can predict when they're going to happen.
Yeah.
Even though you can turn on your television any given moment and find lots of people predicting what the market's going to do, nobody can predict the future. Nobody. And so people say, well, there was this guy, and when the market crashed, he predicted it, and so obviously he can do it, but he can't repeat it. I mean, that's as silly as saying, oh, Stephen won the lottery. Congratulations. Stephen has figured out how to pick winning lottery numbers. Well, no, nobody thinks that about lottery winners. People are smart enough to recognize that Stephen just got extraordinarily lucky. Doesn't mean that he can repeat the process. There's no indication of that at all. So whenever you hear of somebody who successfully predicts what the market's going to do, remember, just like the lottery is filled with people buying every possible number combination, the media is filled with people making every possible prediction of what the market might possibly do. And some of them are going to win the lottery, both playing the lottery and playing the lottery of predicting the stock market.
It's funny, Joe, you mentioned about blizzards and storms. There was one recently over here in Scotland, that Storm Arwen it was called, I believe. And I was actually working on the Friday, and I was getting the train back, and it was like 4:30 in the afternoon, and all the trains were being cancelled because the whole line from like Aberdeen all the way down to Newcastle was, not running because of, trees that had fallen onto the tracks. And I ended up getting onto rail replacement coach, and that coach decided to take me as far as a border town called Berwick, which is in England, but it's about 30 miles from where I live in Scotland. And I think it was because where I live, it's near the sea. So they made that decision that they didn't want to drop us off anywhere near there. But the town I was in had hardly any accommodation. I managed to get a room with a leak. It was the last room that was available, and I just wanted shelter because it was so bad out there. But I ended up stuck there for 2 days because there was no bus, no taxi driver would take me out. And it just thought it was quite funny that you mentioned that. Just thought I'd bring it up. But yeah, it was just difficult.
And the corollary of that would be if having had that experience, if you had said at that point, that's done, I'm not going to live in Scotland anymore. Because of that one incident.
Yeah.
But people do that with the stock market all the time.
You're right. They just sell out. Yeah.
Yeah. The market does what the market can be expected to do, which is to periodically drop, sometimes dramatically. And people say, oh, this is just gambling. I'm not going to invest anymore.
Yeah.
Instead of saying, oh, this is a normal part of the process. And the market otherwise is a wonderful place to have my money, just like Scotland, other than that event, and that those kinds of events presumably will happen in Scotland as they will anywhere else in the world.
Yeah.
It's a wonderful place to live.
Definitely.
In fact, my wife and I, by the way, spent our honeymoon in Scotland. So,
oh, great. Nice.
A long time ago, but we have very fond memories of Scotland. So anyway, you don't pack up and leave Scotland because of bad weather days.
No, definitely.
You shouldn't pack up and leave the stock market because it drops periodically.
Yeah, that's great. That's very true. So on the subject of behavioural investing, investing has gotten very popular, especially with the youth of today. Many different investment apps are available on people's smartphones where you can almost invest in anything, anytime. I've also picked up that people are now checking their portfolios regularly, which can lead to making silly or stupid mistakes like buying and selling at the worst times. What are your thoughts on this, and how often do you check your own portfolio?
So this goes back to something we touched on a little bit earlier too.
Sure.
All of these applications and allowing you to buy and sell things instantly on your phone falls under, in my mind, the category of investing as entertainment.
Yeah.
It's investing as amusement, investing because it's fun, it's exciting, and what have you. That's fine. People can do whatever they want to do with their money. They can go to Las Vegas and play craps. But they should understand they're not investing.
Yeah.
That's gambling. When people talk about the stock market is like a casino and it's gambling. That's the kind of activity that they're talking about, and that's legitimately true. If you're buying and selling all the time, you're not an investor. You're a speculator. You're a trader. It's a very different animal. It's the same kind of animal that haunts the tables in Las Vegas. If that's what you want to do with your money, it's your money. It's not, by and large, a way to success. Most people, the vast majority of people, leave their money in Las Vegas. They don't make money doing there. The vast majority of people who actively trade, who speculate, lose money. But there you go, and that's goes back to what I was saying. I don't want my money to entertain me. I don't expect it to entertain me. I expect my money to work for me, and so I'm not the least bit interested in actively trading on my phone.
Yeah.
I hardly trade. I mean, when I buy VTSAX, my holding period is forever.
Yeah.
And I mean, not just my life, but generationally forever. Ideally, my heirs will hold it forever, and their heirs will hold it forever, and their heirs will hold it forever,
Yeah.
unless, of course, they've moved into that global fund we talked about earlier,
Yeah.
which they will then hold forever.
Sure.
And the only time to sell is, if you're living on your portfolio and you're pulling that 4% a year, which is the basic guideline, and even then you're only pulling 2% because it's throwing off a dividend of about 2%. So yeah, I mean, I'm buy and hold. So I could care less how easily some app makes it for me to buy and sell.
It's funny you talk about investing, like, or they're doing it for the entertainment side, because I've got colleagues at work that we have a really decent 401k or pension, where really generous, like, company match, and a lot of people aren't taking advantage of that at all. Like, they're putting the bare minimum to their pension, and also they speculate on crypto, or some company that they've heard they think is going to do really well, and they're not even doing the basics, where they can double their money or double match their money or whatever. It just but they're putting their faith in crypto because they're convinced it's the future, and it won't even be the main crypto. It will be ones that funny ones, meme ones, that sort of thing. It's just it's just terrible.
Yeah, well, and so, I mean, they hear the stories of people.
Overnight success.
Well, I had the guy who does the tech support for my blog is a fellow named Lucas. And Lucas is very knowledgeable about crypto. He's an investor in it. And back in 2017, I asked him to write a guest post on the blog for it. And then again, in the spring of this year, I wrote a post about crypto, and then I asked Lucas to follow up with a post on it. I don't invest in crypto, but I wanted him to present his point of view, which he did. And of course, the question comes up, well, JL, do you wish that you had invested in crypto back in 2017? Crypto in this case meaning Bitcoin. Well, of course I do. I mean, with hindsight giving me 2020 vision, Bitcoin from 2017 till now has done extraordinarily well. I mean, obviously, I wish I had sold everything and put it all into Bitcoin when Lucas wrote that guest post.
Yeah.
The problem is that I only know that in hindsight with 2020 vision. So that's not really the question. The question is, am I willing to sell everything and put it into Bitcoin today for the next 4 or 5 years? And the answer to that question is absolutely not. Now, maybe 4 or 5 years from now, I'll look back and say, wow, crypto has done, as it did this past, extraordinarily well, and I should have done that. But again, people have to be very careful not to confuse hindsight, which is always 2020, with a good investing strategy for the future. So, for instance, you can always look back and find, if with hindsight being 2020, you can always find an investment that has outperformed VTSAX over the last year, 5 years, 10 years, 20 years, whatever. I mean, it's not hard to do when you're looking at history. The problem is you could not have picked that back then unless you were extraordinarily lucky. There was nothing that would have told you that is the investment that would have done better than all the others you could have chose from. So the question isn't, did crypto outperform VTSAX over the last 5 years? And the answer to that is soundly it did. The question is, will it in the next 5 years? Well, maybe, but maybe not. And I know that the American economy, which is what VTSAX represents, is probably pretty reliably going to do well in the next 5 years.
Excellent.
And certainly in the next 10, 20, 50.
Yeah, I totally agree. I know your strategy of choice is generally 100% stocks, equities up until when you are close to retiring or reaching your financial independence number, and then sort of switching into at least 20% bonds and say 80% equities. In the UK, we don't have a total bond market. The closest I've seen to mirroring this is something like a 60% allocation to UK government bonds, intermediate, and a 40% allocation to UK investment grade bonds, corporate bonds. With bonds not paying much interest these days and inflation getting up, do you think this is still a wise option, and have you considered any alternatives? I have heard you mention corporate bonds before, that you were looking into that only as opposed to like the total bond market option, but just wondered if you had any thoughts or if you changed anything recently.
Well, yeah, taking that last first.
Yeah, sure.
Several years ago, and I want to say probably around 2015, 2016, somewhere in that time frame, I experimented a little bit with bond funds that were not as broad based as the total bond market index fund, but for various reasons were paying higher interest rates. And then I wrote a post which people can find on my blog called something like the bond experiment or what have you. And ultimately, it occurred to me as I was doing this, I'm chasing an interest rate return. So I'm chasing performance in doing that. And the fact is that equities if you want performance, equities are where you want to be.
Yeah.
Bonds are not typically going to provide you performance. I thought, well, why would I do that? If I really want to tilt my portfolio to more risk, which these other bond funds also add, to get more performance, better to tilt it to more equities to get that, which also has the more volatility as well. So that's when I abandoned that experiment. The first part of your question, though, is with interest rates so low and inflation beginning to sort of, actually inflation is here,
Yeah.
and with interest rates potentially rising, do bonds make sense at all anymore? And in fact, I just a couple of weeks ago put a post up about that very subject called "Are Bonds Done?" with a question mark, and my answer to that is twofold. One, you have to understand why in my strategy we hold bonds. We don't hold them for the interest.
Yeah.
Now, the interest is nice, and it's certainly nice to have that revenue stream, but basically we're holding bonds as ballast for the volatile stock market.
Yeah.
Because we already talked about, the stock market is very, very volatile.
Yeah.
And, it's probably the same reason that, if you live in a part of the country that has tornadoes, you have a cellar you can hide in when tornadoes come.
Yeah,
You've got the expense of building it. You don't maybe use it otherwise, but on that rare occasion when the tornado comes, it's good to have the cellar to go down to. And that's what the bonds do. So I'm not owning them for capital gains. I'm not even owning them for the interest that they pay, although I'm happy to take that. And so the fact that they're paying little or no interest, too bad. I wish they were paying me more, but that's not why I'm owning them. The second part of that question is, well, with high inflation and with rising interest rates, the value of bonds in your portfolio are going to drop, because when interest rates rise, bond prices fall. That's a little counterintuitive, but it's not hard to understand if you think, well, if I've got a 10,000 pound bond that is paying, and they're not these days, but to make the math easy, that is paying 10%, So I'm getting £1,000 a year in interest, and interest rates go up to 15%. Well, nobody's going to buy my £10,000 bond for $10,000 because they're going to take their 10,000 or for £10,000, they're going to take their £10,000 and buy a new bond that'll pay them 15%. So my bond is now suddenly worth less. That's because interest rates have risen. So that's the dynamic. But when you own bonds the way we own them in the Simple Path to Wealth, which is to say in a broad-based index fund of bonds, in the case of the U.S., the VTSAX, which is the total bond market fund, you own bonds of all different maturities. And moreover, that fund has bought those bonds at all different times. So at any given point, there are some bonds in that portfolio that are maturing, which means that they are paying back the principal that the fund can then use to buy the newer bonds that are paying higher interest rates.
Yeah.
So the effect of bond prices going down with higher interest rates is moderated pretty significantly by owning them in a broad-based fund. So that's how I own them. But if you own individual bonds, which I don't recommend, then yes, that's a sharp risk when interest rates rise that the value of your bond is going to drop. Now, of course, if you hold that bond to maturity, assuming that the issuer doesn't default, then you'll get all of your principal back, regardless of interest rates.
Yeah.
Yeah.
That's good. That's interesting. Yeah. So, Joe, talking about inflation, my wife's is Venezuelan, and you'll be aware of how controlling inflation has been over there for a while now. I know stocks can be a good hedge for inflation. Can you explain why this is?
Well, first of all, when you have the kind of inflation that Venezuela has endured, or that Zimbabwe endured, or that Germany endured in the 1920s, which led to the rise of the Nazi Party, there's really no place to hide. That's hyperinflation, and that's really, really ugly. But fortunately, that's also pretty rare, and a country has to make a lot of mistakes to trigger something like that. Unfortunately, Venezuela has done just that.
Totally.
They're not the first, they won't be the last. But in the kind of inflation that we're facing here in the U.S. and that I'm guessing you're facing in Europe, it's a much more moderate kind of animal. And of course, what inflation means is that it takes more and more dollars or pounds or yen or euros to buy a given object, right?
Yeah.
A given thing. So if you own a business, you own an operating entity that has assets that will also inflate with the rest of the economy. And that business presumably has some pricing power, so it can charge more for its products as inflation drives up its costs for its raw materials or its labor or whatever. So that's how owning a business provides an inflation hedge. And when you own stocks, you own, in a very real sense, a piece of a business, or in the case of broad-based index fund, pieces of lots and lots of businesses. So that's what provides the inflation hedge, or that's how equities provide the inflation hedge. Now, when inflation ramps up, it frequently can be, at least for a while, bad for the stock market because it's disruptive and the market doesn't like disruptive things. But over time, you have inflationary protection by owning pieces of businesses, just like you have inflationary protection by owning real estate. You know, you own something that you're going to benefit from inflation. In fact, in other than the most severe cases of inflation, the people that it really hurts the most tend to be the poor and the middle class who are living paycheck to paycheck because they're not saving part of their money. They're not investing because those people don't own assets to protect them from inflation.
Yeah.
And that's how they get hurt. If you're middle class and above and you are investing, you're saving part of your income and you're putting it into assets, like stocks, then inflation is a much less scary thing for you. So that's kind of the tragedy of inflation, is it's a huge tax on the weakest, the people who are weakest financially in a country or an economy.
Great. So, having read through your book and obviously the stock series, which I absolutely love, I've noticed you have a lot of respect for Vanguard. Just wanted to ask, why do you like Vanguard so much? And obviously, just to let you know, myself included, you're not alone in liking them. But yeah, just wanted to get your take on it.
Forgive me, I got to plug my computer in here, or it's going to
It's okay.
disconnect, and that'll be the end of our conversation. I just noticed how low my battery was.
That's fine.
So, Vanguard, yeah. So I mentioned earlier that Jack Bogle started Vanguard back in 1975. He's the guy who created the first index fund, which was based on the S&P 500. And he also structured Vanguard to be owned by the investors. And to my knowledge, it's the only financial services firm that is structured in that fashion. And it makes a profound difference, because what it means is that what's best for the investors in Vanguard is perfectly in sync with what's best for Vanguard. Because when you own Vanguard funds, you, by extension, own Vanguard. The distinction is that if you have any other investment firm, they're really serving two masters. And by the way, this is not some insidious conspiracy or some terrible evil thing. This is the way most companies are structured, and almost by necessity.
Yeah.
Let's start there. In fact, let's look at Apple Computer, right? So Apple as a company serves two masters. They serve their customers, and because their customers can buy phones or computers or whatever from all kinds of different places. So Apple is motivated to put out the most competitive product they can at the most competitive price, so they can sell as many of them as they can. But they also have a second master other than their customer, and that's their shareholders. And of course, their shareholders expect a return on their investment, and that's a reasonable thing. So Apple is always going to be trying to sell as many devices as possible at the highest price as possible to provide the best return for their other master, their owners, at the same time serving their customers. It's the same thing with most investment firms. So Fidelity or T. Rowe Price, which are two other big investment firms here in the U.S. Fidelity is a privately owned company. T. Rowe Price is a publicly traded company. They certainly want to create funds and investments that benefit their customers, because otherwise their customers go away. But they also want to provide a handsome return to their owners. And that creates a conflict of interest, because they are always going to be motivated to charge as high a fee as they can on those financial products. Vanguard, the investors and owners at Vanguard are one and the same. There is no distinction. So Vanguard doesn't have any motivation to charge as high a price as possible for their financial products, because that would just wind up in the pockets of the people who are investors anyway.
Yeah.
So Vanguard is structurally organized to continually drive down prices. Now, from a competitive point of view, other financial firms have learned that they need to offer index funds, which are inherently less profitable than actively managed funds, but competitively, they've become so dominant that, these other firms have to offer them. And sometimes they've offered them even at lower prices than Vanguard does, as loss leaders. That's good for the investor, I suppose, but I have a couple of problems with that. Number one is they can change that policy anytime.
Sure.
And they are motivated to change it for reasons we already discussed, to benefit their shareholders. But the other thing is, you bring out a fund, as Fidelity has done, where you have no expense ratio, you are charging nothing, you're offering it for free to your investor. Well, it's not free to operate that fund. All that means is that other investors in Fidelity are picking up the tab for that fund, and the investors in the free fund are getting a free ride. Well, I have an ethical problem with that. I have an ethical problem with taking the costs of that fund and putting it on the shoulders of your other customers, even though it might benefit me temporarily. So that's my thoughts on that.
That's interesting. Another point I wanted to make about the UK, like we have Vanguard in the UK. It's been a good few years now, but I actually found out quite early on that there are some other brokers or platforms that you can, still invest in Vanguard, but the broker might or the platform may be cheaper than Vanguard. So you get to still buy Vanguard funds, but you may not be charged a percentage fee to have them, or it might be like a fixed price basis. So in my example, I use Fidelity for a self-invested personal pension, and they sort of cap out at £45 per year. But it allows me to obviously buy the Vanguard funds. So I know it's kind of strange to be, going to Fidelity to buy Vanguard, but I just find it works out good. And there's a couple of other companies like Halifax and iWeb that are quite good for buying like Vanguard through them, if you know what I mean. But yeah, I don't know what your thoughts on that are.
Well,
I think you're direct to Vanguard, aren't you, in the US? But I don't know. Yeah,
I'm direct to Vanguard. I do know in the US there are other financial firms that allow you to buy Vanguard funds, or for that matter, the funds of other companies, and hold them in your portfolio within their firm. I think Schwab does that.
Yeah.
I think Fidelity also does that. Okay. I can't, obviously I can't speak to the situation in the UK. You know that far better than I do, and
sure. So
I'll let you explain that to your listeners. I wouldn't have anything to offer on that subject.
That's okay, no problem. So I work in the pensions industry, and I have a really hard time convincing my colleagues to look more into investing or even into their own, workplace 401k, pension and what it's invested in. I noticed in your book, Simple Path to Wealth, and the blog series, the stock series, it was written for your daughter as a kind of guidebook on how to invest and get yourself set up for success. My wife and I, we've recently had our daughter born in June this year. And I'm trying to figure out. Thank you. Cheers. I'm trying to figure out what's the best way to teach her this sort of stuff, because I'm really interested in it. My wife's not so much into it, and I'm just wondering, should I be writing things down to help her and guide her? One of my biggest regrets was not learning this finance stuff earlier, but I guess no time like right now. So just wanted to hear what you think about that.
Well, I mean, it's a great question, but you're asking a guy who failed with his own daughter, managed to turn her off to it. So I'm not sure I have a good answer to that. My daughter likes to tease me now that, if she'd listened to me when she was young, there'd be no blog, there'd be no book, there'd be no Chautauquas, So in a way, it's a blessing that I turned her off and she didn't listen. But I don't know the answer to that question. I suppose that I would say don't push it as hard as I did, but make it a regular part of your dinner table conversations,
sure.
and, about money and investing, and let them pick it up at their own pace. But I mean, you're kind of you're asking the guy who failed utterly for advice on this subject. I'm probably not the best source.
But you've helped so many others, so it all worked out, I think, in a good way. So I know that obviously from time to time you update your blog. I know that you often appear on podcasts and interviews, and of course your book, The Simple Path to Wealth, is growing in popularity daily due to word of mouth, which is kind of reminds me of the movie Shawshank Redemption, that when it first came out, there was some reviews that, some people didn't really get it, and then it was more people that had seen it on video and watched it and recommended it. And I feel that, I don't know if you agree, your book to me feels like that, where people, talk about it and recommend it to each other, and it kind of spreads that way. But I just wanted to ask, I know you did touch on it a little bit. Do you have any plans to do another book?
Well, I just brought out a second book. Literally a week ago, we just published a second book. It's a very different animal than the Simple Path to Wealth. I think some of my readers who have been asking for a second book are probably have in their mind Simple Path to Wealth 2.0.
Yeah.
This is not that, but it's a cautionary tale about real estate. The title of it is How I Lost Money in Real Estate Before It Was Fashionable.
Okay.
It is the sad, true tale of the very first real estate I bought as a young man, a condo in Chicago, which was an unmitigated disaster, one disaster after another. If somebody had sat down with me and said, okay, here's a list of all the mistakes you could make buying real estate, both from an investment point of view and a personal point of view, see if you can go out and make all these mistakes in one investment. Well, I would have checked most of those boxes. So what was a very painful experience and expensive experience at the time, and a painful memory for a couple of decades or several decades, is now I can look back on it with amusement, and now I can look back on the lessons that it taught me. And so I wrote this book telling that story, and I think it's written in an amusing way, and the people who've read it enjoy it. It's fun, but it's also hopefully instructive, and not just about real estate, but about investing in general. And it's like the Simple Path to Wealth. It's dedicated to my daughter, and in the dedication I say, should she ever choose to buy real estate, may she do it with her eyes wide open. And, and it's also illustrated. So I found an illustrator who just does brilliant work. And again, this is a fairly humorous book. And as I say, only after decades was I able to see the humor and write it. But it's a fairly humorous book, and Nicolette's illustrations are every bit as entertaining as the writing is, maybe more. So it's very different from the Simple Path, very visual. It's a true story, but it's a story. And then I draw out some lessons that I've learned from it that other people might want to take from it. So, and I love the cover that a woman here in the U.S. just designed. So I'm excited about it and proud of it. So thanks for asking.
Brilliant. No, looking forward to reading it. And I take it once it's available, it will be out on through your website or Amazon. Would that be the best place to pick it up? Yeah.
It's on Amazon. Theoretically, it's available in bookstores. I say theoretically because bookstores, I've learned, have limited shelf space, and so just because you publish a book doesn't mean it goes into the bookstore. But certainly, you could always go to a bookstore and they would be happy to order it for you. So, great. And especially, I think you can only get the hardcover through the bookstore. I don't think you can get it through Amazon, but you can get the Kindle version or the paperback version through Amazon, certainly. And then I've been asked, am I going to do an Audible version, an audio?
I was just about to ask that, because everyone's really a big fan of your audio version of Simple Path, sort of thing.
Yeah, the Simple Path audio.
Got a great voice.
Well, thank you. And it was very well received. And we're talking about doing an Audible version of this. The problem is, because it's an illustrated book, I'm not sure how you do an audio version of an illustrated book, because the illustrations are, at least in my mind, are a big part of what makes the book enjoyable and complete. But it also occurs to me that there have to be other illustrated books that have audio versions of them, and so somebody else has figured this out. So once I figure out what the solution is, hopefully we'll do an audio version. Maybe it'll come with the illustrations as part of it that people can look at while they're listening. I'm not sure. Again, I don't know how it works, but hopefully there'll be an audio version at some point.
Well, Jay, it's been a pleasure having you on. As I say, thank you again for all your content that you put out on the internet and through your book. It's been amazing. It's helped me a lot. It's given me a lot of ideas and helped a lot of people. So just really grateful for that. Obviously, in the show notes of this podcast, I will link below your blog and any social media you have. But where would you say is the best place for people to find your work online?
Well, the place to start is the blog, and you're gonna, as you mentioned, you'll link to it. It's jlcollinsnh.com, and from there you can find me on Twitter, on Facebook. You can also find both the books are front and center on the blog, and you click on the images, and that'll take you to Amazon if you're interested in those. So yeah, the blog is kind of the central part of everything that everything else revolves kind of around the blog, I guess. So
yeah, I mean, you could spend hours just going through the comments on your blog of like what people think about what you've said, and I've spent days where I've just gone down and down just reading them, and it's so good, like hearing what people think. It's a great community you've got over there, so it's excellent.
It is a great community, and it's an international community, and a very smart one.
Definitely.
And yeah, I'm very proud of the content on it. And I'm also very proud of the people who participated in it. As you say, in fact, a lot of the best material I think is found in the comments, including my own responses to some of the comments. So yeah, so that's why I'd go there first. And then if you're going to put show link notes, don't forget to do that little video that we talked about, because
definitely.
Just warn people that they'll see a very different persona than they've listened to.
Yeah, of course.
Our interview here today, and a lot of harsher language.
Brilliant. Okay, well, thanks very much, JL.
It's
great catching up with you.
My honor. Thank you for the invitation. I've had a blast.
Thank you. Thanks very much. Cheers.
Cheers.
Thanks.